What are the best ways to track economic performance? Imagine trying to understand how well a country is doing without looking at any data. It's like trying to read a book without opening it. To truly grasp a nation's economic health, we relying on specific tools called economic indicators. These indicators are like a report card for the economy, showing us how it's growing, slowing down, or facing challenges. They come from national income accounting, which is a way to measure all the economic activity happening within a country. The most common measure is gross domestic product, or GDP. Think of GDP as the total value of everything produced in a country over a certain period, usually a year or a quarter. It can be calculated in 3 ways. First, the production approach adds up the value added by all sectors like farming, manufacturing, and services. Second, the expenditure approach totals what households, businesses, and governments spend, plus net exports. Third, the income approach sums up all the incomes earned from producing goods and services, like wages, rents, and profits. Adjusting GDP for inflation gives us real GDP, which shows true growth without the effect of rising prices. Dividing GDP by the population gives us GDP per person, helping us understand living standards. Inflation is another key indicator. It shows how prices are changing over time, affecting what people can buy. The Consumer Price Index measures the average change in prices for a basket of goods and services that typical households buy. If prices go up, inflation is occurring, which can reduce the purchasing power of money. Other indices look at prices for exports and imports, helping us see how international trade is affected. The unemployment rate tells us how many people who want jobs cannot find one. It's a sign of how well the labor market is doing. A high unemployment rate suggests the economy isn't using its resources efficiently, while a very low rate might mean wages are rising and inflation could follow. Trade indicators like the trade balance show whether a country is exporting more than it imports. A trade surplus adds to GDP, while a trade deficit subtracts from it. The terms of trade compare export prices to import prices, indicating how favorable a country's trade is. Productivity measures how efficiently workers produce goods and services. When productivity improves, it means more output is generated with the same or fewer inputs, which supports sustainable growth. Financial market indicators like stock market indices and bond yields also provide clues about economic health. Rising stock markets often reflected investor confidence, while bond yields can signal expectations about future interest rates and economic conditions. By keeping an eye on these indicators regularly, economists and policymakers can see if the economy is expanding, contracting, or facing inflation or unemployment issues. They use this data to make decisions about interest rates, government spending, and other policies to keep the economy stable. Investors and businesses also watch these signs to plan their strategies and investments. In short, the best way to track economic performance is by combining data from GDP, inflation, employment, trade, productivity, and financial markets. Together, these measures give a clear picture of how a country is doing and where it might be headed.